Start the recording. All right. Yes, Shoe Black is a sole trading, operating as a retailer. The following information is extracted from his books at 31st December 2017. Right. So we've got all this information, and then what our additional information. Okay. So let's go through the additional information first. Every time you're answering these type of questions for financial statements, always read the additional information first because that's where there are going to be some adjustments. Okay. Here we have closing inventory 1,660,000. Right. So we are closing inventory. Trade balances totaling 6,000 are to be written off, and the allowance for doubtful debts is increased to 30,000. All right, so here we've got two things here. We've got bad debts and allowance for doubtful debts. So before I go to bad debts, or what did I say last time about allowance for doubtful debts? In that previous, remember in that other question where we had that allowance for irrecoverable debts, it's also called sometimes allowance for doubtful debts, same thing. What does it represent? Wow. Okay, allowance for irrecoverable debts or allowance for doubtful debts. Okay, this is an estimation of how much money you might not get from your receivables. Okay, then when you hear debts being written off or bad debts, here you're sure that this money is not coming back. Okay, so this 6,000 here, okay, has to be deducted from the receivables amount because we are sure we're not receiving it. Okay. Then this allowance for doubtful debts. Remember, if there is a decrease in the allowance for doubtful debts, how did we treat it last time in the previous question? Do you remember how we treated the decrease in the allowance for doubtful debts? Yes. Madam Helen, you've raised your hand. Mhm. Yes. Excuse me. Yes. Go ahead. Mhm. And that 100 kwacha was a decrease, right? In the allowance for doubtful debts. Yes. So remember that 100 kwacha on the income statement, we added it to gross profit, right? Because we treated it as a gain. Okay. Now here, the allowance has increased. It hasn't decreased. It has increased. So it means we're expecting not to receive more money. So here it's going to be treated like a loss, an expense. All right. So this 30,000 here. Uh huh. Yes. Yes, this 30,000 is going to be deducted in the statement of profit or loss. Okay. Then, since we've already got the amount for the allowance, where is it here? Yes, allowance for doubtful debts, 18,000. Okay. So since it has increased by 30,000, so it means the allowance for doubtful debts is 48,000. Okay. Because from 18,000, it increased by 30,000. So it means the new allowance for doubtful debts is 48,000. Are we together on that part, colleagues? That 30,000, which was mentioned down there, they said there's been an increase. Okay. Mm-hmm. Here. So they've told us it is increased. So you add 18 plus 30 to find the new amount. So it has increased from 18 to 48,000. No, because they've already told us here that it's increased to it's increased to 30,000. Okay, not by 30,000. It means it's increased to 30,000. So we have to find out how much it is. Thought it was increased by 30,000. It has increased to 30,000. So actually, Sai, it's gone from 80 to 30,000. So we have to tabulate the increase. So 30 minus 18, that is 20. Not mistaken. No, that's 20. 12, yes. So it means it has increased by 12,000. Okay. The allowance for doubtful debts, it was 18,000. Now it is increased to 30,000. So we'll have to find out by how much has it increased? 30 minus 18. It's increased by 12,000. So this 12,000 is going to be what is deducted in the statement of profit or loss. And then this 30,000 is also going to be deducted. We deduct it from the trade receivables. Yes. The only difference between allowance for doubtful debts and bad debts written off is that allowance for doubtful debts, you can estimate, then you find people pay you. So when people pay you, then there's some adjustments that you need to make. But debts written off, it's written off, it's not going to come back. Maybe the person has died. Maybe the person's business has closed. Okay. So you're sure that okay, this one's not coming. This is not coming back. But with the allowance, you estimate, say, okay, this might not come back. But if should any come back, there'll be some adjustments. I hope we are clear on the difference between the two. Bad debts or debts written off, you're sure it's not coming back. Okay. You have a confidence level of 99%. Okay, well, let's add some statistics in here. You've got a confidence level of 99% that people, that man is not coming. See that the person has died, okay, and no one can resurrect and just come to pay you back your money. That's impossible. Or maybe the person's business, the person who's owing you business, owing you money, his business has closed down. So there's, unless the business reopens and whatever, then yeah. So you're sure with dates written off. Then with allowance, okay, it's just an estimation. Okay, it's estimating. You can estimate wrong. That's why you estimate wrong, then there'll be an adjustment needed to be made. Okay. Yes. Any questions, colleagues? Salaries and wages owing 190,000. Yeah, 190,000 with 70,000 paid in advance. So here we've got two things. Okay. We've got an accrued expense and we've got a prepaid expense. Okay. So this is how you deal with them. Maybe let me write this down here so that you have study notes. Yes. Colleagues, what's an accrued expense? Do you remember what an accrued expense is? It's an expense that when it falls due, you do not pay it. And it keeps building up. Okay. So how you treat it in the with the in these financial statements, all right? In the income statement, add the accrual to the actual expense. In the balance sheet, include the accrual as a current liability. Okay, that's how you treat accrued expenses. Okay, then a prepaid expense. All right, this is an expense you pay for in advance. In the income statement, in the income statement, you subtract from the actual expense, and in the balance sheet, include as a current asset. Okay, so here wages, salaries and wages owing 190,000. So we'll add it to the salaries and wages expense. All right. And then there's also a 70,000 paid in advance. So we also subtract from the salaries and wages expense. All right. So you add this 190,000 because it's an accrued expense, and you subtract this 70,000. It's a prepaid expense. Then this 190,000 will appear in the balance sheet as a current liability. This 70,000 will appear in the balance sheet as a current asset. Are we okay with that, colleagues? Hmm. Mm-hmm. 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 Just to make life easy, sir, don't overthink things, okay? There are a lot of things that happen in businesses. Don't overthink it, okay? Don't overthink it. Just know for this type of question, okay? For this question, just know that okay, 190,000 since it's owing, it means this is an accrued expense. We haven't paid it yet, so we're owing it, right? And then obviously, and then a 70,000 has been paid in advance. So it's a thing, a prepaid expense. So what was happening in Joe Shoe Black's bakery for that to happen is beyond our knowledge here. Maybe the people who prepare such questions should be thinking about these things. Yeah, I think they should be because a lot of questions bring a lot of confusion. Okay. So, sir, just for now, just okay. Don't overthink things. Yes. The important point to remember is just when you have an accrual, just hold on, Mr. Foster. When you have an accrual, you add. When you have a prepayment, you subtract. Mr. Foster, no, I'm not showing it. But yes, I'm not showing it at the moment. Hmm. Can you see it now? Okay. Yes. Or I'll try that thing where you log in and log out. If that one doesn't work out, maybe just keep on trying. Just keep on trying. But don't worry, sir, it's being recorded also. All right. The screen. Okay. Okay. I think, okay. I think network. Okay. All right. So here again, we have distribution expenses of 60,000 were prepaid and 120,000 not paid. So the same scenario here. You have got a prepaid expense, 60,000, which are going to deduct from the amount which is on this on in that trial balance. All right. Then this 120,000, since it wasn't paid, so it's an accrual. So you're going to add, you are going to add interest of 50,000 is owing. So again, also this we are on. This is a current liability. Okay. It's also an accrual, so you add also. In January 2018, the business received invoices for credit purchases totaling 18,000 for goods delivered before 31st December. So this 18,000, you're going to add it to the purchases expense. All right. These credit purchases, you're also going to add the purchases expense. So let's go and make the financial statements. Most of these adjustments, we can even do them within the financial statements. Seems depreciation here. There's no calculation for each. The depreciation. No. Okay, so let's start. Um, Hold on, let me just go switch off the pump. Okay, so what's the first item that goes into the trading account? Yes. Yes. Sales revenue, the first thing that goes in. How much you made from selling your goods and services. All right. So here, sales. Okay. So these are in millions. Okay. These numbers here, they're in millions. Okay. So here it's 30 sales here, which is represented as 13,600 is actually 13,600,000. Okay, colleagues, when you see this here, this K triple zero here, it means for each number, add three zeros. Okay, yes. If we want, we can keep it like this. But it means this information in the additional information, we have to remove three zeros. So to avoid anyone being confused, what does the majority say? Should we put them as their actual figures or we shorten them knowing that each number has three zeros attached? I think it's best to add. We keep yeah, I think that would be the best. That way to make life easy. Okay. Now, what usually comes next in the trading account after you recorded your sales revenue, how much you've made from sales? What's the next item? Before that one, before sales returns, I'll be looking for sales returns. Okay. I just want you to remember every time after this, after you put in your sales revenue, the next thing you should look for is return inwards or sales returns. If there's no, well and good. Here we have Oh, so I have to even put this figure in the middle. Okay, after sales, it's sales returns or return inwards. Okay, so here sale return inwards. This is 400. We add three zeros, 400,000. Okay, so we get our net sales. What's it doing now? Okay, so this is our net sales. Okay, do not memorize this. Okay, just remember after you record how much you made from selling your goods, you want to first see were there any refunds that were needed to be given. Okay, yes, return outwards, it's you're taking the goods back to the supplier. Return inwards, the customer is bringing the goods back to you. It's return outwards. So it's very important we remember let me be writing this down also. Colleagues, get screenshots. Okay, so sales returns is also called return inwards, which return inwards. Um, Purchases returns, return outwards. So sales returns, it's a contra revenue because it reduces the thing. It reduces your sales revenue. Okay. Purchase returns is a contra expense because it reduces your purchases expense. Okay, colleagues, are we okay with that? Okay, the next item is we need to get our cost of goods sold. Okay, because remember, gross profit is sales revenue minus cost of goods sold. Yes. Mm-hmm. Okay. Majority of all of these were going to be in the second column, right? Your opening inventories, everything else. Okay. The second column, the second and first columns are for where you're doing the initial calculations. Okay. Then the last column is where you're putting the totals. So the only thing that will come in this first column is going to be when you're doing purchases, add carriage inwards, deduct purchases returns. That will be the only one that you're going to do in this first column. Everything else is going to come in this second column. Okay. So, madam, just remember, first two columns, that's where you're doing your calculations. Final column, that's where your totals are coming in. Yes. So we have to get our cost of goods sold. So our cost of goods sold equals opening inventory plus purchases okay. It's just that purchases has got some adjustments that need to be made. Okay, but basically cost of goods sold. Oh, to get the cost of goods sold, it's so you have to get the total cost of goods available for sale minus closing inventory. So this what I'm writing here, this is how we get the total cost of goods available for sale. All right. So we're just adding inventory and purchases. That gives you the total cost of goods available for sale. Once you've got the total cost of goods available for sale, then you deduct your closing inventory, and that's how you get your cost of goods sold. Okay. So here, our first item, as someone said, we have to put in opening inventory. Okay. Second column. As I said, most of these things are just going to go in the second column. So our opening inventory 1st January 2017, 1530, then we add three zeros, that's 1,530,000. Next is purchases. Now remember in our um, additional information, we say we've got credit purchases of 18,000. So this 18,000, we need to add it to our purchases expense. So here, purchases expense, I hope we're able to see clearly. Purchases expense is 8,100,000. Okay. So 8,100,000 plus 18,000. Let's get our calculators. 8,100,000 plus 18,000. So that we get our purchases expense. 8,118,000. 8,118,000. 18,000 plus 8,100,000. Are we okay with this, colleagues? Any questions, queries? Yes. Plus, 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 plus. Excuse me. Okay. Next thing. What's the next item that comes in? Carriage inwards. Colleagues, what is carriage inwards? Yes. Okay, when goods are coming to your premises and you are charged a delivery charge, that is carriage inwards. What about carriage outwards? Wonderful, sir. Are you an accountant? Are you an Hmm. Maybe it's you who should take control of the lesson. You've explained it so well. Let's get our total. 8,818,000. The reason why I've still kept this total would have gone here. But the reason why it's still kept here because we have to deduct purchase returns or return outwards. Here's what is it called here? What did they use? Return outwards. Okay, so return outwards is here 150,000. Okay, remember we're adding two zeros. That's why I've said 150,000. Okay, so our after we do our adjustments, this is our purchases. So now we get our total cost of goods available for sale. So we add opening inventory plus our purchases here. $10,198,000. This is the total cost of goods available for sale. Now remember, in order to get our cost of goods sold, it's total cost of goods available for sale minus what? What are we deducting from total cost of goods available for sale? I just showed the formula some minutes ago. You've forgotten? We deduct closing inventory. Closing inventory is where, let's see the totals here. Closing inventory is how much? 1,660,000. So to get your cost of goods sold, that's what I've highlighted here in yellow. Cost of goods sold, total cost of goods available for sale minus closing inventory. Please remember that. Okay, and format is key with these financial statements. So that is the cost of goods sold. COGS, cost. Other box you see cost of sales. Okay. If you are a manufacturer, then it's cost of goods manufactured. So to get our gross profit, it's our revenue minus the costs we incurred in getting our goods, purchasing our goods in order to resell them. 4,662,000. That is our gross profit. Any questions? Now I have to be switching to the third years. So 05, we're meeting this 05 hours. Please, Mr. Vincent, please call me. I don't know, what should we look at? Is that, oh, it's mathematics.